Have you been asked to calculate net present value, otherwise known as NPV, and you're not quite sure how to do it? Well, I'm Professor Capko, and you've come to the right place because I'm going to show you just how easy it is to calculate that today. And if this problem looks familiar, yes, I did this in a recent video in which I helped you calculate the NPV using the tables. You know what? We're not going to do that today. Let's do it the easy way. We're going to get rid of those tables and we're going to welcome ourselves to the 21st century and we're going to use a financial calculator. Yes, we're going to do this calculation using our BA2 Plus calculator. It's a financial calculator from Texas Instruments. I love mine, and if you want to get one, I've got one linked in the description and in the on the screen. So you can get one for yourself as well. And it will make it so much easier than using these tables because we won't need all this information here regarding the annuity factors. Now, if you want to see that, if you don't have a financial calculator and you want to know how to do it using the tables, well, I've linked that video up here in the corner for you, so you can go ahead and do that if you were going to be in the caveman days. But now we're in the modern days and we're going to figure this out. Now, as you know, or you may recall, NPV is net present value, and that is when we're evaluating a particular investment of some sort, a project, a piece of equipment, something, and we're going to compare the money going out and the money coming back in. And it's not just going to be a simple, well, more money came in than went out, because obviously, if less money comes in than went out, then that's a bad investment. But even if more money comes in than went out, we still have to compare that to our company's required rate of return. And this company, in our example, requires a 10% annual return. So if it doesn't make that with the money invested, and in our problem here, it's investing $4,000, and if it hasn't invested $4,000 and get a 10% annual return, well, then it's not going to be considered a good investment. We're going to get into exactly how to do this, but first I want to say something wonderful is about to happen for you. So be on the lookout for it. And now back to the video. All right, so we're investing in this example $4,000 into some project, and it's expected, we never know for sure, nothing's sure in finance, but we're projecting it to generate net annual cash flows of $2,000 over the next 3 years. So they're going to buy this project or put money into this project, $4,000, and at the beginning, and then the first year they're going to get $2,000 back. The second year they're going to get $2,000 back, and the third year they're going to get $2,000 back. We're going to take that, and that of course is $3,000, and we need to discount it back using present value because obviously a dollar today is worth more than a dollar in the future. So that $2,000, for example, 3 years from now is not going to be worth as much as it would be today. Just look at the prices in your grocery store and how they go up and how inflation will eat away at that. So any time you are looking at the present value of a dollar, we want to look at that it's worth more today than it is in the future. The NPV calculation takes that into effect. And because it's a net present value, it's not just the present value of the cash flows, it's the present value of the cash flows minus the original investment. So if you saw in that previous video, we did the present value of the cash flows and then we subtracted out the $4,000 that had to be laid out to purchase this investment. In this case, the calculator, our lovely BA2 Plus, does all that for us. So let's see how we do this. So I'm going to turn it on, and I feel like I've had too much coffee this morning. And we're going to clear out everything first. So we're going to clear out the time value of money. So we hit the second button, that yellow button, and you see CLRTVM. That's time value of money. Hit that. We're clearing that. Second button, we're going to hit again, and we're going to clear this clear work. CLR, and then work. We're going to do that. And then just for make sure everything's clear, I'm going to hit the CE/CE/C button. All right, so everything's cleared out. Now let's start entering our numbers. We can see here, I'm going to move that over, that we have an initial outlay of $4,000. So that's going to be our CF, our cash flow. So I'm going to hit that. And CF0, that's our original cash flow, $4,000. So I type in the 4,000 and it's going out. That money is going out. So it's reducing our checking account. Our cash account goes down by 4,000. So I hit the plus minus and turn it into a negative 4,000. Once I've done that, I hit the enter button. There you go. So I've now entered our initial cash flow. This arrow down button right there, I'm going to hit that next, and it takes us to our cash flow one. Our first cash flow is $2,000. So $2,000, I put that in there, and it's going to be positive because that's cash coming back into the company. That's a net cash flow, so they've paid taxes or whatever, and the $2,000 comes in. So that's cash flow one. I hit enter again. Now here's the thing, and I did a previous video on calculating NPV with where the cash flow wasn't steady. This is like an annuity, the cash flow is the same every year. If the cash flow changes, then you have to do this somewhat slightly differently. And I did that in a video that I've linked up here for you. So take a look at that if your cash flow varies. Now, in this one, the cash flow is the same for 3 years. So I can do a little trick here. The next thing I do is hit this arrow down, see it here, arrow down, and it asks me how many times this cash flow occurs. Well, it's got it as 1, but actually the $2,000 happens 3 times, year 1, year 2, and year 3. So I can change this FO1 to instead of a 1, I'm going to change it to a 3, and I'm going to hit enter. So you following along? So that tells me that that $2,000 cash flow happens 3 times. There's no cash flow 2 because that's already been incorporated into our cash flow that I said happens 3 times. So the next thing we're going to do is hit this NPV button. See it right there? I hit NPV and it gives me I equals. That's asking me for the interest rate. Our interest rate, our required interest rate is 10%. So I'm going to type that in. You're going to type it in as a percentage. You don't hit the percentage button. You just type in 10. Do not put it in as a decimal. So I'm not going to put it in as 0.10. I'm going to put it in as 10. Very important to do that. And I hit enter. Okay, so now I've had the enter. Okay, so I've got the interest rate in there. We've entered the 4,000 cash flow out. We've done the $2,000 in 3 times, and we've got the interest rate. I'm going to hit this arrow down, and it tells me NPV 0. Don't panic. We're not done yet. It hasn't calculated it yet. So I'm going to hit compute button. We hit the compute button, CPT, and that computes it. And in this case, it is $973.70. So that is a positive NPV. So that is a good investment. If it's a negative NPV, then it would be a bad investment. And if it's a 0 NPV, then it could go either way. But in this case, it's positive. It's a decent positive number. So if we are confident that this will actually return this $2,000 a year for 3 years, then this is a good investment. That is all I have for you today. If you want to support this channel, there's a join button down below. And if you hit that and become a member, there's special members only benefits that you don't want to miss out on, such as live chats, priority questions and answers. I might make a priority video for you if you've got a question on how to do something. And also there is advanced, you get the videos sooner. So our members see the videos first. So for a very low monthly subscription, you can get that. But if you just want to subscribe to this channel, because I am trying to reach 20,000 subscribers before my birthday, and you might be the one that makes the difference. So hit that subscribe button and then hit the notification bell so you never miss a video. Now make it an awesome day. Thank you.